Ladies and gentlemen, gather around and prepare to embark on an unforgettable journey into the exhilarating world of stocks and financial wizardry. Welcome to Stock Marketpedia, where the stock market meets showtime. Let's kickstart this electrifying adventure together and redefine what it means to be the stock market superstar. So without further ado, hit that play button, fasten your seatbelts, and let the financial extravaganza begin. Get ready for a wild ride because Stock Marketpedia is here to rock your world. Stocks occasionally become available at undervalued prices, and it doesn't require a high IQ to recognize their cheapness. However, it does demand a temperament that is willing to take action promptly. Warren Buffett, the 92-year-old Oracle of Omaha and CEO of Berkshire Hathaway, is widely renowned as the world's best investor. Every year, he shares a letter with his shareholders, providing insights into Berkshire Hathaway's stock returns since he assumed leadership in 1965. Astonishingly, Buffett has averaged a 20.1% annual return, surpassing the market's average of 10.5%. Berkshire Hathaway's total return over this period amounts to a staggering 3.6 million percent compared to the S&P 500's 30,000%. In this video, we'll delve into Warren Buffett's advice, specifically applicable to the investment landscape in 2023. Presently, the market is experiencing a decline, having dropped by 20% in 2022. Additionally, there's a concern about high inflation, although there are signs of it easing. Furthermore, rising interest rates are expected to persist in 2023 as the Federal Reserve aims to bring the inflation rate back to 2% and will continue raising rates until that objective is achieved. Considering these factors, along with the potential for a significant recession throughout the year, investors have much to contemplate. Let's commence by exploring Warren Buffett's insights in this context. Advice number 1. Investing while interest rates rise. We must address the third significant challenge of investing this year: rising interest rates. How can we navigate the situation when interest rates continue to increase? What Warren Buffett said: interest rates, basically are to the value of assets what gravity is to matter, essentially. And if I could reduce gravity, it's pulled by about 80%. I'd be in the Tokyo Olympics jumping. Interest rates can be compared to gravity in the stock market. When interest rates are low, it becomes easier and cheaper for both individuals and businesses to borrow money. This leads to increased spending, higher profits, and overall economic growth. This has been the case over the last decade. However, as interest rates start to rise, borrowing money becomes more expensive. This means that businesses face challenges in repaying their debts, and consumers have less disposable income to spend. Consequently, it becomes a tough environment for businesses to operate and thrive in, which often reflects in their financial results and impacts their stock prices. Let's examine a graphic of the past 5 years to understand the relationship between interest rates and the stock market. In 2018, interest rates increased, and during that period, the stock market experienced minimal growth. Conversely, when interest rates began to decline in 2019, the stock market witnessed an upward trend. When the COVID-19 pandemic struck, the Federal Reserve lowered interest rates to near zero levels, resulting in a booming stock market for about 2 years. However, in 2022, interest rates surged, causing the stock market to plummet by 20%. The impact of rising interest rates on stocks can be attributed to two factors. Firstly, businesses tend to perform poorly, leading to a decline in their stock value. Secondly, the role of government bonds must be considered. U.S. Treasury bills and Treasury bonds are typically viewed as risk-free investments. When interest rates are low, the returns on these bonds are relatively low. However, as interest rates rise, the government issues new bonds with higher interest payments. Institutional money managers who aim to generate favorable returns with minimal risk for their clients find these bonds more appealing. Consequently, a substantial amount of professional money flows out of the stock market and into the safety of treasury bonds, resulting in a decline in stock prices. Warren Buffett, the renowned investor, discussed this concept back in 1982 or 1983. He noted that when the yield on long-term government bonds reached 15%, a company earning a 15% return on equity would be valued at no more than its book value. This was because investors could purchase a 30-year strip of bonds, guaranteeing themselves a 15% annual return. In such circumstances, a business earning a 12% return was considered subpar. However, when the government bond yield dropped to 3%, a business earning a 12% return became highly desirable. Buffett emphasized that as the risk-free rate decreases, businesses with higher returns become increasingly valuable and sought after by investors. This phenomenon drives their stock prices to soar. To simplify, if a business offers a 10% annual return on investment, it's considered good. However, as the risk-free rate approaches 10%, professional investors tend to sell their shares in that business and instead invest in government bonds. This shift in investment preference causes the stock price of the business to decline. Advice number 2. Investing during high inflation. During a period of inflation, rising material prices impact consumers and businesses. Consumers may have less purchasing power, affecting demand. Higher interest rates can limit borrowing and impact investments. Investors may seek inflation-resistant assets. Businesses need to adapt strategies to manage rising costs. Monitoring inflation indicators is important for informed decision-making. What Warren Buffett said. He said it many years ago that it's an invisible tax that only one man in a million really understands. The best investment against inflation is to improve your own earning power. The best passive investment, I think, is a good business. If you own an interest in a good business, you're very likely to maintain purchasing power no matter what happens to the currency. But it's interesting, in the United States, the value of the dollar since I was born is declined by 94% to 6 cents. But things can work out pretty well even during inflationary times. I mean, if somebody told me when I was born, the dollar bill is going to go to 6 cents, I might have said, let me go back. I'm not interested in emerging into that kind of a world, but actually it's worked out pretty well, so I have no complaints. During periods of high inflation, it's important to consider certain concepts. First, focus on improving your own earning power to keep up with rising prices. Enhancing your skills and value to employers can lead to increased income that aligns with inflation. Additionally, Warren Buffett suggests implementing a passive strategy of investing in high-quality businesses to counteract inflation. In his 1981 shareholder letter, Buffett outlined the characteristics of businesses that can effectively combat inflation. Firstly, these businesses should have the ability to raise prices easily, even when demand for their products is stagnant and production capacity is not fully utilized. They should be able to do so without risking a significant loss of market share or unit volume. Secondly, these businesses should be able to accommodate substantial increases in dollar volume, primarily driven by inflation rather than real growth, with only minimal additional capital investment. To further explain the second point, Buffett emphasizes the importance of scalability. Scalable businesses can handle a significant increase in business volume without requiring substantial financial investments to expand their capacity. For instance, a social media company can display 3 advertisements instead of 2 with minimal cost, while a car company like Ford or Tesla would need significant capital expenditure and time to increase production by 50%. However, it's the first point that carries utmost significance in investing during inflation. Businesses must possess the ability to raise prices without losing market share or unit volume. This implies that these companies have a competitive advantage or a moat that grants them pricing power. What Warren Buffett said. When you go into a drugstore, 7-Eleven or something, and you say, I would like a Snickers bar, and the owner says, oh, I've got something, the Mosk bar at 10 cents off the Snickers bar. You say, give me the Snickers, and if it doesn't give you the Snickers, you go across the street and buy the Snickers. It's probably easier to develop a new car that compete with stickers, but some products have terrific models in them. Probably Elmer's glue does, WD-40 people that have an iPhone, they want to continue with the product that they've got. They want the new version. It's just easier for them. They've learned how to do everything and their lives built around it, and all of that and much are very useful. Costco has a mold in people's mind. I mean, Amazon can raise the price of Prime, 20, and you can't do that unless you build something within that image of the Amazon Prime that's based on reality that you're going to get a lot for your money. And you're going to want to use it, and then you can raise prices $20. But if you're selling, if you're selling some commodity problem and product, you can't do that. You need a moat. There are various types of competitive advantages, known as moats, that companies can possess. Examples include patents, toll collections, powerful brands like Coca-Cola, Apple and Louis Vuitton, and Costco's reputation for offering the best prices. These moats provide companies with the ability to dictate prices, also known as pricing power. During a period of inflation, companies with strong moats are more likely to thrive. They can offset increased costs and lower profits by raising the prices of their products, while their competitive advantages protect them from experiencing a significant drop in sales. A notable example is Coca-Cola, which saw an increase in sales when they raised their prices. Therefore, focusing on companies with pricing power and robust moats is a valuable approach to navigating the inflationary landscape in 2023. Advice number 3, investing in bear market. As rational long-term value investors, how should we respond when the stock market is consistently declining? Let's talk a little bit about the fact that the market's down almost 800 points this morning. Yeah, concern for you? Well, no, that's good for us actually. I mean, we're not a net buyer of stocks over time, and just like being a net buyer of food, I expect to buy food the rest of my life. And I hope that food goes down at price tomorrow when stocks are down. We're going to be buying on balance, and who wouldn't rather buy it, a lower price at a higher price? People are really strange on that. I mean, because most of your listeners are savers, and that means they'll beat up buyers, and they should want the stock market to go down. They should want to buy at a lower price, and they have that feeling that they just feel better when stocks are going up. Buffett's logical thinking is evident in this video segment. For long-term investors who are aiming to accumulate wealth and are below the age of around 55, a declining stock market can be beneficial. This is because they are still in the phase of actively buying stocks. However, individuals who are around 70 or 80 may prefer a consistently high stock market as they are likely to be net sellers of stocks at this stage of their lives. Buffett emphasizes that many people react emotionally to a falling market, feeling more comfortable buying stocks when the market is on the rise. In reality, though, it's during times like the present when the stock market is significantly down that one should feel more confident about purchasing stocks. This aligns with the popular investing quote that states, "The stock market is the only place where people run out of the store during a sale." It's worth considering why we eagerly participate in shopping on Black Friday but become apprehensive when similar market conditions occur. Long-term investors should actually embrace a declining stock market as it presents opportunities rather than causes for concern. To summarize, the key to investing during a bear market is to focus on owning great businesses and to recognize that market corrections are a regular occurrence in investing. Rather than being fearful, these downturns should actually bring a sense of satisfaction. The main lesson to learn from all this is that we should focus on how our chosen businesses are performing and think about the long term. Stocks generally tend to be better investments than bonds over a long period of time, although there may be short-term fluctuations. As stock market investors, we should stay focused on the long term and take advantage of lower stock prices to invest in high-quality businesses. We can't control what the Federal Reserve does, so let's concentrate on playing the long game and buying great businesses at good prices when interest rates are high. That's how we deal with a high interest rate environment. Overall, this is Warren Buffett's advice for handling the three major investing challenges we'll face in 2023: a stock market correction, high inflation, and rising interest rates. That's a wrap for today's video, but the excitement doesn't stop here. Get ready for more mind-blowing content coming your way. We'll be pumping out videos 3 to 5 times per week, so buckle up for an exhilarating ride. Drop your comments below with your topic requests because we want to hear from you. And don't forget to smash that like button, subscribe, and hit that notification bell to stay in the loop. Stay tuned for the next thrilling episode on Stock Marketpedia, where we make stocks sizzle.